Welcome to the Deep Dive, your shortcut to being genuinely well-informed, cutting through the noise to get you the crucial insights. You know that ancient saying, maybe Chinese, maybe not, may you live in interesting times.
Hmm.
Well, looking at the global economy this century, I think it's safe to say we are living in exceptionally interesting times.
Absolutely. I mean, think about it. A major financial crisis, a global pandemic, and then this resurgence of inflation that really blindsided a lot of people.
Exactly. And these aren't just separate events, right? They're connected. They're changing things.
They are fundamentally reshaping how we think about central banking, about global trade, about, well, almost everything economic.
Mhm.
So our mission today is to really dig into that. We're drawing on two key sources: the Federal Reserve Board's analysis on central banking post-crises and the World Bank's latest global economic prospects.
Right. And the goal is to pull out the really important stuff, help you understand the core challenges, and maybe some surprising facts about where things are headed.
Exactly. We want to distill it down for you.
Okay, so let's start with central banks. They've really been in the hot seat, haven't they? Navigating just completely uncharted territory.
They really have.
And at the heart of it all, it still comes down to price stability.
Yeah.
That's job one, right? But why is it so fundamental, especially now?
It's fundamental because high inflation isn't just an abstract number. It has these real concrete costs. Very insidious ones, actually.
Like what?
Well, think about it. It's like a tax on just holding cash. Your money just loses value sitting there.
Eroding away.
Exactly.
Yeah.
And that pushes people, pushes companies to maybe overinvest in the financial sector, just trying to find ways to escape those costs.
Okay, so it distorts behavior.
It does. And then there's something called nominal illusion. People kind of struggle to see the real impact of rising prices. It makes financial planning incredibly hard.
Like trying to budget when your measuring stick keeps changing.
Precisely. And you see it in surveys. People really, really dislike inflation for good reason.
So it's not just an economic issue, it's almost a social one too.
Absolutely. And what's interesting, the source points out that price stability and high employment, they aren't really long-term trade-offs. They actually complement each other. You need stable prices for sustainable job growth.
That's a key insight. So, okay, managing the numbers is one thing, but there's this huge psychological piece too, isn't there? Expectations, independence.
Oh, massively important.
Yeah.
We've known about the natural rate hypothesis for a while, the idea that you can't permanently boost employment with inflation because people's expectations adjust.
They catch on.
They catch on. And this leads into the rational expectations revolution back in the 70s, folks like Robert Lucas. They showed that what people expect policymakers to do really affects the economy now.
Okay, so anticipation matters. How does that play out?
It leads to this tricky thing called the time inconsistency problem.
Time inconsistency sounds complicated.
Well, the idea is simple enough. Imagine you're a policymaker. You might be tempted, just maybe, to create a little surprise inflation,
Why would they do that?
to get a short-term dip in unemployment, maybe before an election or something. A quick economic boost.
Ah, the temptation for a quick win. But there's a catch.
Big catch.
Yeah.
Because, again, people anticipate this temptation. Markets anticipate it. So if the central bank isn't seen as credibly committed to low inflation.
People just expect higher inflation anyway.
Exactly.
Yeah.
You end up with higher inflation, but you don't get that short-term employment gain. It's a trap.
So you get the pain without the gain.
Precisely.
Mm.
And that's why central bank independence, specifically instrument independence, the freedom to set interest rates, is so critical. It shields them from those short-term political pressures.
Right. It lets them focus on the long game.
It builds credibility. There's a striking example. The Bank of England in 1997.
What happened there?
When they were granted independence, you could see market expectations of future inflation. The 10-year break-even rate dropped noticeably on the day of the announcement.
Wow. Just the announcement itself changed expectations.
It shows how powerful that signal of independence and credibility is.
Okay, so independence for price stability is crucial. But their job description seems to have expanded, right? Financial stability is now a huge focus.
It really is. It's now seen as essential for both price stability and general economic stability. You can't really separate them anymore.
And that includes the whole lender of last resort function.
Yes, the classic beige-hot idea from way back in 1873. The central bank's unique power to create liquidity, to basically pump money into the system during a crisis to stop it from collapsing.
But doesn't that create problems, like if banks know they'll be bailed out?
Absolutely. That's the moral hazard dilemma. It can encourage banks to take on too much risk.
So that's why central banks often end up supervising banks, too, to manage that risk.
Exactly. Supervision becomes part of the package deal when you're the lender of last resort.
Makes sense. But what about using the main policy tool, interest rates, to deal with financial risks, like trying to lean against credit bubbles?
That's a really hot debate. And the Fed source we looked at is pretty clear on
That's
this.
their take.
They argue the case for using monetary policy specifically to lean against bubbles is actually not strong.
Really? Why not? Seems intuitive.
Well, they suggest it can be a violation of the separation principle. Basically, it risks distracting the central bank from its core job, price stability, and might not even be that effective against bubbles anyway. Might be better to use other tools like regulation.
Okay, so use the right tool for the right job. Don't try to do everything with interest rates.
That's the idea. But despite that view, recent events have definitely put financial stability risks front and center again. Concerns about financial dominance are back.
Financial dominance, meaning financial problems dictating monetary policy.
Kind of, yeah. Like, think about the volatility in UK pension funds in late 2022. The Bank of England had to step in.
Right, the LDI crisis.
Then the U.S. bank failures in March 2023, Silicon Valley Bank and others. And the forced acquisition of Credit Suisse, a globally systemic bank, in Switzerland just a couple months later.
So, major scares, forcing central banks to react, potentially compromising their inflation fight.
It highlights the tension. These events show just how intertwined monetary policy and financial stability have become, whether policymakers like it or not.
Okay, so these challenges mean the old playbook isn't always enough. The toolkit has had to evolve beyond just setting interest rates.
Definitely. Those traditional rules, like the Taylor rule, which try to mechanically link rates to inflation and output, well, they didn't perform so well during the big crises.
Why not?
They just weren't built to handle massive financial disruptions, like we saw in the global financial crisis or with COVID.
So what else is in the toolkit now? We hear a lot about forward guidance.
Right. Communication is a policy tool, basically telling markets what you plan to do. There are different flavors.
Yeah.
There's unconditional time-based guidance saying something like, we won't raise rates for 2 years.
Seems simple. What's the downside?
The risk is you lock yourself in, even if the economy changes dramatically. You might ignore important new data, and it could even backfire if conditions improve faster than expected.
Okay, inflexible. What's the alternative?
Data-based forward guidance. This is more like, we'll keep rates low until inflation hits X or unemployment falls to Y. It's more flexible, adapts to how the economy actually evolves.
That sounds more sensible. And then there's the big one, QE. Quantitative easing. Became a household phrase, almost.
Almost, yeah. It's essentially the central bank creating new money to buy assets, usually long-term government bonds.
To do what?
To push down long-term interest rates, encourage borrowing and investment, and just generally stimulate the economy, especially when short-term rates are already basically zero.
The zero lower bound problem.
Exactly. Japan pioneered it, the Bank of England used it in 2009, the ECB later, and then pretty much everyone, including many emerging markets, jumped in during 2020-21.
Was it just for stimulus everywhere?
In advanced economies, mostly yes. In some emerging markets, it was also about just keeping markets functioning during the extreme stress of the pandemic, making sure buyers and sellers could still trade.
And this QE led to huge central bank balance sheets, right?
Absolutely massive. If you look at the data, the median central bank balance sheet relative to GDP went from under 10% in the early 2000s to over 70% in 2021.
70%? That's incredible.
It came down a bit since to around 35% by late 2022, but still, it's a huge structural shift, unprecedented power and presence in the markets.
So if QE is stepping on the gas, what about the brakes? That's quantitative tightening or QT, letting those assets run off or selling them?
That's the idea, yes. The opposite process, shrinking the balance sheet.
Is it having equally dramatic effects?
It's harder to tell, actually. The source notes that identifying the effects of QT is tricky.
Why is that?
Because it's mostly been well telegraphed, anticipated by markets. So you don't get those big surprise announcement effects like you sometimes did with QE.
So it's more gradual, less impactful, maybe?
Policymakers have even described it as being like watching paint dry. Intentionally slow and predictable, hopefully boring.
Hopefully. Okay, which brings us neatly to the big inflation spike of 2021-22. And this ties back to that zero lower bound issue, doesn't it? The idea that interest rates can't go much below zero.
Exactly. There's this concept of a low equilibrium real interest rate, or R star. R. Basically, the natural underlying interest rate in the economy seems to have fallen over recent decades,
Meaning?
meaning that even in normal times, interest rates are likely to be lower than they used to be. And that means central banks are much more likely to hit that effective lower bound, or ELB, essentially zero, when a recession
How
hits.
much more likely?
Some research suggests, with standard policies, they might hit that zero bound more than a quarter of the time.
Wow. So their main tool is often just unavailable.
Right, which makes fighting downturns harder and might mean relying more on those unconventional tools like QE and forward guidance.
This actually led some big names, Blanchard, Krugman, Ball, to suggest raising the inflation target, didn't it? From 2% to maybe 4%.
It did. The logic was, if inflation averages higher, then nominal interest rates will also average higher, giving central banks more room to cut rates before hitting zero.
Makes sense on paper. Why didn't central banks jump at that?
They mostly resisted. The main reasons cited were the sheer difficulty of re-anchoring public expectations at a higher target after decades of aiming for 2%.
The credibility risk.
Huge credibility risk. Losing public trust would be disastrous. So, recent policy reviews, US, Euro area, UK, Canada, generally stuck with the 2% target, maybe with tweaks like average inflation targeting.
Aiming for 2% over time, allowing some overshoots.
Yeah, allowing inflation to run a bit hot after periods of being too low. But then, of course, inflation really ran hot in 2021-22.
It certainly did. Core inflation hit 5, even 10% in major economies. What drove that surge?
The analysis points to a combination, really, a perfect storm. You had major supply chain disruptions from the pandemic, factories shut, shipping chaos.
Right, couldn't get goods.
And at the same time, you had excess aggregate demand, fueled partly by massive government stimulus packages. Lots of money chasing fewer goods.
A classic recipe for inflation.
Pretty much. And the source does critically examine the Fed's framework at the time, that temporary average inflation targeting.
What was the issue there?
The lack of clarity, perhaps? It wasn't really clear over what period they were averaging or how much of an overshoot they'd tolerate. That ambiguity might have added to the policy challenges during that critical period.
Okay. So central banks are juggling all these new tools, old constraints, and this recent inflation shock. Now let's broaden the lens. How does this fit into the wider global economic picture? Let's turn to that World Bank report. It sounds pretty downbeat for 2025.
It is quite sobering, yes. The headline forecast is for global growth to slow down markedly to just 2.3% in 2025.
How bad is that historically?
It's the slowest pace since 2008, if you exclude the actual recession years of 2009 and 2020. It's very slightish, and it's a big downgrade from what they expected earlier.
Is this slowdown concentrated somewhere, or is it widespread?
That's a key point. It's expected to be broad-based. They anticipate slowing growth in nearly 60% of emerging market and developing economies, EMDEs. So it's not just one region dragging things down.
60%, that's a lot. What are the main drivers of this global weakness?
Several key things. Increased trade barriers and just general policy uncertainty are big ones.
The trade wars and protectionism effect.
Yes. Then there's weaker external demand, partly because growth is also slowing in the big advanced economies. And lower global commodity prices, oil prices, for instance, are forecast to drop 10% in 2025.
Lower oil prices sound good for consumers, but bad for the global economy overall.
It signals weaker demand, yeah. Now, the report does mention some potential upside risks.
Any good news?
Well, possibly. A cooling of trade tensions, maybe more negotiations. Perhaps governments coordinate to loosen fiscal policy. And interestingly, they mentioned the widespread deployment of AI as a potential boost.
AI as a wild card. Okay. But sticking with the downsides, that theme of a fractured global economy seems central. Trade tensions, protectionism.
It's a major feature of the outlook. The World Bank's baseline forecast actually assumes that the current high tariff levels stick around.
So the damage is baked in a way.
In their main scenario, yes. And these tariffs, they can hit investment goods particularly hard, making it more expensive for businesses to invest. Plus, it just creates this cloud of uncertainty.
Right. The report even mentions a speculative view that the U.S. might be using tariffs to try and force manufacturing back home, reshoring.
Yes, that's mentioned as one potential factor contributing to the uncertainty around trade policy, and the result is this reconfiguration of global value chains.
Companies shifting production.
Exactly. We see examples like U.S. firms maybe investing less in China, more in places like Mexico or Vietnam, trying to diversify or avoid tariffs.
Does this reshuffling have a big economic cost?
Potentially huge. The report estimates that this kind of fragmentation and reshoring could lead to global output losses of up to 5% in the long run.
5%. loss of global GDP. That sounds catastrophic.
It's an enormous potential cost. Think about what 5% of global GDP represents. It's trillions of dollars every year. It could seriously set back development and living standards globally.
Wow. And related to this fragmentation, there's this trend of FDI in retreat, foreign direct investment is falling.
Yeah, that's another worrying trend. FDI, companies investing directly in businesses in other countries. As a share of GDP in the typical EMDE, it's fallen quite a bit.
From what to what?
From a peak of around 5% of GDP back in 2008, down to just over 2% in 2023.
That's a big drop. Why is that happening?
It's a mix of factors again, the hangover from the global financial crisis, then the pandemic shock, high debt levels in many countries, the recent inflation and monetary tightening, and woven through it all, those rising trade barriers and general fragmentation.
Why does less FDI matter so much for these developing economies?
Because FDI isn't just money. It often brings technology, expertise, access to markets. It can be a real engine for growth.
How much of a boost?
The analysis suggests a 10% increase in FDI can lift GDP by about 0.3% after 3 years. And that boost can be much bigger, maybe up to 0.8% in countries with better institutions, more skilled workers, and more open trade policies.
So the conditions matter for benefiting from FDI.
Absolutely.
Yeah.
And interestingly, FDI is also shifting more towards the services sector.
Away from manufacturing.
Increasingly, yes.
Yeah.
Which means investing in education and skills. Human capital is becoming even more crucial for EMDEs if they want to attract and benefit from this changing pattern of investment.
Okay, skills for a service economy, which leads directly to another huge challenge highlighted.
Yeah.
The jobs challenge in EMDEs. It sounds like a demographic wave is about to hit.
It really is.
Yeah.
Between now and 2030, something like 600 million young people are expected to enter the working age population across EMDEs,
600 million.
with a net increase of maybe 250 million, factoring in older workers leaving. And the problem is, many of these economies are already struggling to create enough jobs now,
Which regions are most affected?
particularly places like Sub-Saharan Africa, South Asia, and the Middle East and North Africa. Job growth there often isn't keeping pace with population growth, especially for young people.
What are the consequences of that mismatch?
It means slower progress in catching up to advanced economy income levels. It hinders poverty reduction efforts. It can lead to social unrest. It's a really fundamental development challenge.
A huge challenge. And then there's an even tougher subset of countries, the fragile and conflict-affected situations, or FCS.
Yes, the report devotes significant attention to these 39 EMDEs. We're talking about over 1 billion people living in places plagued by instability, conflict, weak institutions.
And the economic impact is devastating.
Just devastating. On average, high-intensity conflicts lead to a cumulative GDP per capita loss of around 20% after just 5 years.
20% wiped out.
Yeah. Or look at it another way. A 1% rise in conflict, deaths per million people, can cut per capita GDP by nearly 4% over 5 years. There are specific examples. GDP in West Bank and Gaza forecast to shrink 27% in 2024 alone.
Unbelievable.
And places like the Central African Republic, South Sudan, Syria, their GDP per capita could easily have been twice as high today, if not for conflict.
Just staggering human and economic costs. Are these countries also facing debt problems?
Severe debt problems. 70% of them are either already in debt distress or at high risk of it.
So very little fiscal space to deal with anything.
Exactly. And the humanitarian situation is dire. FCS economies account for half the world's extreme poor. In 2024, 18% of their population faced acute food insecurity.
18%, compared to what another EMDE?
Compared to about 1% in other EMDEs,
Yeah.
the difference is stark.
What about their underlying economic structure?
Generally very weak, low investment, very little FDI coming in, underdeveloped financial systems, makes it incredibly hard to build any resilience.
And climate change must hit them particularly hard, too.
Absolutely. They're often highly vulnerable to droughts, floods, storms. These climate shocks just pile on top of existing crises, worsening humanitarian needs, and sometimes even fueling more conflict. It's a vicious cycle.
It sounds almost hopeless in some cases. Does the report offer any way forward? Any lessons from countries that have recovered from conflict?
It does look at some examples, places like Bosnia and Herzegovina, Cambodia, Rwanda, Sri Lanka, and it finds common threads in successful recoveries.
So it is.
Establishing peace and security is obviously number one. Then, achieving macroeconomic stability, reforming institutions, opening up to trade, investing in people, health, and education, and, critically, sustained international support, aid, concessional loans, debt relief.
So a comprehensive approach is needed, backed by the international community.
Yes. The priorities are clear. Prevent conflicts in the first place by tackling inequality and exclusion. Where conflict happens, try to protect core institutions like the central bank and legal systems. Protect human capital, strengthen fiscal management, and maintain that international support lifeline.
Okay, so pulling these two big threads together, the changing world of central banking and this challenging global economic picture, especially for developing countries, how do they connect? What's the big takeaway for you?
I think the biggest takeaway is just how deeply intertwined everything is. The challenges central banks are wrestling with, inflation, financial stability, new tools like QE/QT, they don't happen in a vacuum.
Right, they're happening within this context of slowing global growth, trade fragmentation, and these deep vulnerabilities in many parts of the world.
Exactly. For example, that global economic fragmentation we talked about. It doesn't just hurt trade and investment. It can actually make monetary policy less effective within countries.
How so?
Well, if global supply chains are constantly being disrupted or reconfigured, it creates supply shocks that monetary policy can't easily control. It complicates inflation dynamics. And fragmentation makes international cooperation much harder.
Cooperation needed to manage crises, especially in those fragile states.
Precisely. If the world is breaking into blocks, it's much harder to coordinate responses to financial panics, debt crises, or humanitarian disasters. The feedback loops are complex and often negative.
So it sounds like the need for clear communication from central banks and maybe even more international policy coordination is greater than ever, but the environment makes it harder than ever.
That sums it up pretty well. The lessons from the sources point towards needing more transparency, especially around those unconventional tools, and needing conditions that let central banks maintain their independence and credibility.
While governments grapple with these huge global shifts, trade tensions, geopolitics, the crises in fragile states.
Yeah, it's not just a slowdown. The global economy might be fundamentally reorganizing, and that has profound implications everywhere.
What a fascinating, if somewhat daunting, picture. We've really covered a lot of ground. The shifting landscape for central banks after multiple crises, the serious headwinds for the global economy, particularly EMDEs in fragile states, and how interconnected these issues truly are.
It really underscores the complexity and the uncertainty policymakers are dealing with right now. Constant adaptation is the name of the game.
So let's leave our listeners with something to chew on. As we consider all these unprecedented shifts in central banking, in global trade, in geopolitical stability, what do you think is the most critical, unaddressed vulnerability that, if we neglect it, could really derail future economic stability and prosperity on a global scale?